Greetings, members one and all of the Salivation Nation. As I record this video, the articles of impeachment for Donald John Trump have been sent over to the Senate. And with that being said, that kind of is a precipice for the title of this video and why the world's largest hedge fund sees gold rising 30% to $2,000 an ounce. There's just so much boiling conflict. Let's explore. Yes, we close out these alerts here. That's just one example here. But this is from CNBC, and this is an interview with Ray Dalio, Bridgewater Associates founder and president and CIO. Gold prices, which briefly topped $1,600 last week, could rally to $2,000 an ounce amid heightened political risks, Bridgewater co-chief investment officer Greg Jensen told the Financial Times on Wednesday. The manager from the world's biggest hedge fund cited increased income inequality in the U.S. and rising tensions with China and Iran as uncertainties ahead that will prompt more safe haven buying. Bridgewater manages $160 billion in assets, more than any other hedge fund. There is so much boiling conflict, Jensen told the paper. People should be prepared for a much wider range and potentially more volatile set of circumstances than we are mostly accustomed to. Jensen also believes the Federal Reserve would let inflation run hot for a while, which also creates an environment for higher gold prices, as investors tend to use the precious metal as a hedge against inflationary forces. And then it talks about the prices for spot gold and up to 1551 over that 1550 level. And the U.S.-China trade war and Middle East unrest drove investors to more conservative investment for stability during times of tumult, pushing gold prices higher. Earlier last year, the founder of Bridgewater, Ray Dalio, advocated putting money into gold as he saw a paradigm shift in investing due to global central banks' expected moves and to an easier monetary policy. Keep in mind, it was last year when the Bank of International Settlements, which is known as the central bank of central banks, designated gold a tier 1 asset, which is the safest, as long as cash, it is the safest, and it is basically admits that it is money. The Federal Reserve cut interest rates for 3 times last year to combat a slowing economy. Jensen said it's possible the central bank could slash rates to zero this year to avoid a recession and disinflationary pressures. Bridgewater is not alone in recommending the bullion. Double Line CEO Jeffrey Gundlach also said last year he was a buyer of gold on expectations that the dollar would weaken. But take this and from any advice from anybody, even the largest head fund. It is big news when somebody that big or an organization that big makes a prediction like this. But you know what? It doesn't matter. In my view, it's fun to talk about. It's fun to see the reasoning behind it. This is near doom and gloom, my feeling is, because there's a lot of positivity in the economy right now. And there's also a lot of, a lot of news a lot of things that are happening on the positive front in terms of trade deal, phase 1 trade deal being signed. The jury's still out as to the details of that trade deal. But, the USMCA is now going to be heard by the Senate and voted on very soon and signed by the president. So there are other factors that could, potentially mitigate some of these things. Yes, we live in volatile times. There's obviously conflict, even rising tensions with China, even as we sign this phase 1 trade deal, and with protests continuing in Hong Kong. And obviously, Iran, though it's cooled down a bit, could heat right back up again. And then there's North Korea. That heard a whole lot about North Korea as of late. They promised a surprise on Christmas Day. It never arrived. But nonetheless, I do think there is a little bit of volatility geopolitically. Domestically, we have the trial, which most analysts believe that Donald Trump will be acquitted in that trial, but nonetheless, there's always a slight chance that that might not happen. So it might rattle markets, and if one or two senators you move over to the other side and vote to convict, well, that's going to obviously move the markets, I believe, because there's a closer chance of potentially that the president may be kicked out of office. But nonetheless, once we get through that, and then we'll be back to the regular political infighting, which has plagued this nation for quite some time. We're more divided than ever before politically. However, economically, the markets are reacting in such a way that, they react to small news here and there. But by and large, the markets have been doing very well, breaking records, which means that people are upbeat about the economy. Wall Street is not the best indicator of what happens on Main Street. Make no mistake, there is a chasm between the two. However, I believe that if we see real manufacturing and agricultural activity with this deal, and just overall it could spread out, and the economy could do better, especially with a trade agreement between the United States, Mexico, and Canada going into effect. If this happens this year, I think we could stave off a potential downturn in the economy, or at least any fear of a great recession, even though we might have a small recession, but it may not be as big as some had predicted. In fact, many in this community have predicted the next recession will be huge, but it might not be. And I think that might not be because of real economic activity in the free market. I've always said that, there's been times where we've seen the market move, a certain way here and there. And we've seen situations where, especially in the stock market, the Dow Jones, the S&P 500, there's been a lot of injections by quantitative easing and people moving money around, and those in that world. That's sort of an artificial stimulus, It's an artificial bubble that was created during those times to stimulate the economy. But it really didn't have that effect really on manufacturing and some of the real jobs that are starting to come back now to the United States. And that is where we're seeing an increase in the stock markets that is based off of those realities that we face today. So you have a real bubble on top of an artificial bubble. Both could burst. They could burst together. And more likely, it's probably what's going to happen is they will. But the artificial bubble is likely to deflate, hopefully in due course. And that deflation of the artificial bubble will be a normalcy bias that will occur. And then that will hopefully lead to real market activity that will manifest itself. Regardless of what happens with the economy, whether it stays good, whether we have a small recession, big recession, depression, or vice versa, or what have you, every which way, it's always a good idea to accumulate gold and silver, precious metals. Especially gold, I believe, is the ultimate hedge against economic instability, but silver is too. And this is why we hold these metals, because they're self-evident, and they've served this role for thousands of years as money and as a store of value. They'll continue to do that no matter the economic situation. So I would encourage you to press on and move forward and read this headline, that the world's largest hedge fund sees gold rising to 30% for 2000. Even though the weight of it should say something, take it for a grain of salt. Don't go by the advice of what some prediction somebody says, even if it's from the largest hedge fund or from me. Buy at your own pace as you can afford to do so and accumulate accordingly, because there's plenty of the metals around to buy, and more than likely the more you get, or the amount that you buy per month or what have you, is a lot better than most people in the world today. Especially if you consider that, here in the United States, if you have 1 to 2% of the population stacking, holding precious metals, you're doing a lot better. So I would just encourage you to press on at your regular pace and buying. So there you have it. I'd like to extend a multitude of gratitude to you all for watching, and encourage you to please rate, share, comment, and subscribe.